just kind of step in and get started. What is the best way to manage too many open trades? How do you decide when enough is enough? I'm gonna start with you, JC.
Yeah. So, of course, I always say anything I share is things that I've learned through, tears and suffering. So I have been, there's times when I've had like, say, 25 different option positions on, and it's kind of like, the market's going up or whatever it is. You just like so many things. And here's the challenge with 25, like say option trades. And let's say they're all bullish, they're calls and put credit spreads and stuff like that. And then you wake up one morning and let's say the S&Ps have reversed and they just keep selling off, and you want to get out. It is extremely hard to get out of 25 option trades all at the same time. So I think that's probably the biggest lesson. And so what I've done in those situations, if it's like, okay, the market here is looking a little different. Let's say I've got 10 contracts of 25 different positions, so 250 bullish, 250 contracts total. And if I see a day where it's like the markets, maybe it's just not for whatever reason. We all know that there's normal pullbacks, but then there's times like, is this going to be a normal pullback? So do you get out, do you scramble out of all 25 trades? Or sometimes I found that situation, you just kind of figure out what a good hedge is and just say, all right, I'm just going to buy, if I'm long 250 options total, I'm going to buy 100 SPY puts. And I'm just going to sit here for a minute and see how this goes. So part of this is you want to manage your net liquidating value. And that's the biggest challenge I've seen is if you've got, say, 25 positions and things really changed very quickly, that it can take you a long time to work your way out of those positions. Other than that, though, what can really, if you put in the work and you have 25 positions and you just make sure that you can have OCO orders in place, trickier with options because of liquidity and stuff like that. But, if you've got 25 stop losses in place where you don't really have to do anything and, maybe you're not going to get good fills, but at least that's happening. So that's the way around it. So I always say, just make sure that in a situation like that, you kind of want to make sure you have all your ducks in a row with your targets, with your stops. And then, if you're on Thinkorswim and the market action's fast, it can be clunky, things like that. And then the other side of the coin there is just kind of understand what a hedge would be in that situation and be prepared to put it on. And then that allows you a little bit more leisure time to work your way out of everything.
Wise words. Mr. Marshall?
Uh, Sort of the same thing. I would say have a plan for each position. If you've got, my max would probably be 10, 15 trades, but up to 25, whatever you have a plan for each. And this sounds like it's cumbersome and all that stuff, but I go through, and again, we're talking about the difference in maybe 5 or 10 trades versus say 25. I'll go through if the market's doing anything crazy pre-market, the night before ES is selling off, whatever, anything's crazy. I'll go through each one of those positions and see where I am, see where I'm likely to be when the market opens up. So you at least have a good idea what's going on. Again, have a plan for each. John is exactly right. You can have OCO orders, and maybe that helps some, at least kind of gives you a little mental relief, I suppose. But if we take a step back, the way that I like to at least approach it is that if I've got, say, 5 tech names, I mean, like Mag or 7, we got Mag 7s, right? I've got counterbalancing trades such as like right now I've got AEM, gold stock, um, Costco, things that are completely in a different sector that tend to react differently. That helps. It's not a fix all, but it helps, right? The other thing too is exactly what John was saying. If I have a bunch of long delta, for example, I'm all bullish. Think about your time frame. So if these are all options trades and those trades average 30 days to expiration, I may go out 60 days and or buy some SPY butterflies or QQQ debit spreads or something like that. And then I'll hold those for, a week or 2 or 3 or whatever. And as time goes on, I close and I'll roll them out further, uh, versus just buying a big old hedge and just holding it to the bitter end and letting it just completely dissolve, right? So I know I've got some of that covered, and it depends on how the market is trading, right? If there's no reason to be bearish, then I'm not going to put much in the way of hedging on. But but I try to have something as a counterbalance trade and also something if I'm very heavy for it's long short exposure. I'm long in the short term, I'm short a little bit further out, and that kind of balances me out. Unfortunately, there's no hard and fast rule because I don't keep a lot of that hedging unless things are starting to look, questionable.
Henry, as the quote unquote new kid on the block between these two, what are you doing?
Well, I feel like, so to just reiterate the question, at least exactly as it was phrased, is what's the best way to manage too many open trades? How do you decide when enough is enough?
Mhm.
And I always feel like the asking of that question is how you know. Like if you find yourself having to ask another experienced trader, like, I really feel like this is, I'm feeling like this might be enough. That is your
Yeah.
signal that it's enough, right? You know that just by having that thought, you've got too much going on. If you knew that you had a plan and everything was set and you were good, you would never have to ask that question. So if you ever find yourself kind of like wondering, that's the first clue. And then the other part is I will never forget a live seminar that we did. And it was one of the ladies in the very front row. And she was experiencing that exact same thing. And she got the chance to ask John that question. And he kind of walked over there and looked at her portfolio. And it's, probably about 100 positions, maybe a little less.
You're
And he's
right.
like, yeah, and it was great because I don't think he took the mouse. You don't want to get into that, but he was like, I'm going to help you with this because you're going to go to that and close that one, and then close that one, and then close the next one. And it's like you literally get out of them by closing them, and you start to realize that that is the deer in headlights look, right? So anytime you find yourself kind of like one asking the question or really exhibiting the deer in the headlights, just get out. We are some of the very select few that have the ability to get out with that kind of liquidity, right? Like if you're a fund manager with these massive positions, you really can't do that. But as 99% of retail traders, you can right click, close the position, and that's how you get out. And the more that you detach yourself from, oh, I took a loss or whatever it is, the better off you'll be. So I would just say, it's very, very easy to get out. It's all a mental thing. And if you find yourself overwhelmed, that's your first clue that you probably are.
Yep. Vincent said in the chat there, it's best to know where the exits are in a crowded theater, and that
Yes.
pretty much sums it up, right? If you're feeling like you can't manage them all, start closing them. Here's a good question in the chat, and I'm gonna sort of rephrase this a little bit, but is there one setup that you're willing to trade blind? Meaning, I'm guessing
what does
you're
blind?
not,
What does blind mean?
I'm guessing that you don't really have charts. You're looking at price. You don't have your tools. Is there a setup that you're looking at that's just purely something that you're like, nope, I've seen this price level, or I've seen this price pattern, and I don't care what my tools say, I'm in. Is there something that you can do with that?
I think it's a super interesting question. The answer is yes. But I think it's, if I'm looking at just price and I have no tools, and I guess it depends on the instrument too. So say it's a daily chart of something. Well, if I see something that's made new highs and it's pulled back like 10%, and it's got a cup and handle pattern, I think that's going to continue. Also too is something that's been puking and it forms, it's called the W bottom. I think those are actually really powerful. And really there's no indicator that's going to help you with that. And so that is really kind of a pattern based kind of a thing. So if that answers the question, I mean, I think it's super intriguing because, at the end of the day, indicators can help, but they're also, a lot of times just a reflection of price, right? But I'm a huge fan of tools that can kind of help you in certain situations. But yeah, I think it's a fascinating question. I'll keep thinking on it and see if something else pops up.
I like it. Henry, is there anything that you're willing to trade? Maybe it's a symbol, right? Like Tesla. You're willing to trade Tesla blind, for example?
Well, honestly, the very first thing, when I saw that question is there's not a thing in the world I would trade blind, because I feel like that you're kind of, again, it's an interesting question because it's not terribly clear, but it's like you would just do something without looking at a chart at all. Like, I'm just kind of like, no, I wouldn't trade anything blind. Then as I thought about it a little bit further, I was like, there is one thing, and that is when you have a put call ratio that is above one, and you go, like 10 to 15. You can go further if you like, but the time spread thing, it's kind of essentially just doing the out of the money sales of puts through unbalanced butterflies when a put call ratio is above one. So that's kind of blind, right? I mean, that's kind of like, because you're looking at sentiment, and that's always going to happen when the market is, the most chaotic, right? Like it's really selling off. The put call ratio, it has to be above one, something like 1.2 is just that much better. But if the market's getting hit that hard, I'll go, a couple weeks out of the, couple weeks out, a little bit out of the money and do that unbalanced fly. And I would trade that blind.
Cool. Bruce, is there anything that you would do with that?
Well, as I sit here and listen to it, I mean, my first thought was no way. No, absolutely not. But, the more I think about it, if, say, SPX, for example, I could at any time, really in any market, you could go out, and this is not the best risk reward and all that kind of stuff, but you could go out and sell a 10 delta, put credit spread, call credit spread, iron condor, preferably iron condor, 5 delta, 10 delta, doesn't matter where it is, and it's probably going to be an okay trade. Might need a little management in a very trending market, but you could do that. That would be probably, that's the only thing I can think of that I would do completely blind.
It's hard to do it, but that's a great question, Daniel. Thank you. Because look, you made them all think.
Yeah.
You think a lot. Yeah. Let's see. What do you do? I'm going to combine a couple of these because they're kind of the same thing, right? How do you manage when things aren't going your way? There's a couple of different questions. One of them has been, has there been a trade this year that just didn't go your way, and how did you manage it? And another question here is how, the same kind of deal. How do you manage when things are not going your way? How do you stick to this, specifically when things are really not working out for you? Maybe you have a string of losses, let's say. What do you do with that? Does it screw with your head?
Mm-hmm.
So I remember one specifically, and this was it was in February, March, and because I was traveling, Maria and I were doing a trip to Barcelona. It was around that time, and I had bought a pullback on MasterCard, and it was, stock looked great, and I don't remember the exact prices, so I think it was something like maybe $570, 570, and it started pulling back. That's fine. And at one point I added to it. And then typically on something like that, it goes from 570, maybe it goes to 560, 555, and then you kind of get that turnaround. And so I'm not adverse to scaling into a position like that, but it just never recovered. It went to like $535, and my options basically all expired worthless. And, there's, when you go through something like that, there's a couple of things to kind of keep in mind. And it's always something like that. It shouldn't be like devastating, right? And it was more, and something like, I just remember it because I was just like, I was surprised that it kept going down, but I wasn't like adding stock. It was options with a finite amount risk. So it's a nice thing about options is you're like, okay, I'm willing to bet, $3,000 on this or whatever the amount is. And then if it goes to zero, that's fine. But I remember it because I was fairly convinced that, MasterCard would recover and go on. And so it's always good to have that happen once in a while, just to understand that the market doesn't care, right, what you think. And the way that you solve that problem is when you first get into the trade is just, it's like Mark Douglas says, this trade may have an edge and win 72% of the time, but over the course of 100 trades, you have absolutely no idea that if the next trade you take is going to be a winner or a loser. And so if you go in with that attitude, then you start, quantifying the risk and things like that too. And so on things like that, I'll tend to, if things are kind of going my way, I'm positive, I will tend to kind of use a little bit larger size, but it's always a reminder to just say, look, this trade could be the next MasterCard. It just keeps going against you and against you and against you. So just structure your trade accordingly.
And follow up on that a little bit. Is there,
Jerry cries, so that's also
Jerry cries, yeah. Is there a minimum number of trades that you'll take in a particular setup that gives you the confidence in whatever it is that you're trading? Do you have, like Mark Douglas had the experiment, right? So at least 25 trades. Is there, for any of you guys, is there a certain number of trades when you're looking at a maybe a different setup that you haven't used or you haven't used in a while? Is there some way that you are willing to continue to do that until you've decided yay or nay?
Off the top, so I find that stuff like this really comes in with shorter term trades, because like the swing trades are pretty dialed in, but say SPX, 0DTE, there's sometimes like I'll certainly have done trades where it's like, okay, I'm going to do a put credit spread here, and maybe the bottom drops out, or sell a call credit spread and it rallies. And I found that there's times where it's like, okay, I've done 3 call credit spreads in a row, and all 3 have not worked. And so you want to step back and say, okay, is this a setup that I'm following here, or am I trading a belief that I have that is untrue? And if it's a setup and it's a legit setup, I just keep taking it, as long as because you look over the course of 25 trades, did it make money? But I also catch myself on shorter term trades. Is this a belief I have, and the market's telling me that my belief is untrue? Because it's a subtle difference, but it's super, super, super critical.
Bruce, is there a certain limit to that, and how do you work through that?
For me, it's more of a time frame. I want to see something work for, say, 6 months. 3 months is nice. 6 months is pretty much confirmation that it's working. I've been working on an SPX trade that's very weird in how I'm trying to do, and I think it's going to work, but I've been doing it about 2 months, and some work, some don't. Big payoff, that kind of thing. But it'll be 6 months probably minimum before I really have a comfort level of putting any kind of real money into it. So yeah, I mean, it's not 1 or 2 trades or 3 or 4 or 5. And I was talking about that yesterday. You do a trade, it's a new to you, and you do it. It works 3 times in a row. Okay, man, this is it. This is the best trade ever. I'm going to load up and put half my account in it. Don't do that. Right. It takes a lot more than that, because you got to know if that trade works in a fast market or a slow market or an up market or a down market, that kind of thing. And as far as the question of, is this year, I've got the questions over here too. I think has there been any trades this year that didn't go the way you expected? And I've got I've got a couple good and bad. Um, the bad first, TLN, I got in that stock and bullish position, and it started going down, 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 and you got to stick to your plan. And the stock kept selling off, and I'm like, it broke the 20, it got down to 34, and I said, I still believe in it. Everything looks good, but I could not figure out why it was going down. It kept going down, kept going down. Finally, I got to my line in the sand. I said, okay, that's it. I got to pull the plug on the trade. And I believe it was the next day after I pulled the plug on the trade that it gapped up like 60 points, because there was a takeover, a merger. And the reason it was going down is because nobody knew if it was going to go through or not. It went through, stock gapped up, and I missed a huge rally on the stock. But you have to follow your plan, and that's just the way it is, right? On the good side, the plus side, I've had quite a few that have reached my target too quickly this year, too early. So I'll do a butterfly or even a debit spread, and I'll do, just any one of these tech names that have just been on fire, and I will put the trade up 30 points, and we go 30 points in 2 days or something crazy. And I still got 3 weeks left on the trade. It's a good thing. Again, we have to follow our plan. If it's a butterfly and you hit that center target and you're up $100, you just got to take it, because it's, the butterfly's not going to work until you've been in the trade and get closer to expiration. So, that's been my experience this year with this kind of V-shaped move we've had. It's been so insanely quick. But again, that's a good thing. If you get to you have an idea and your profit target is here, and you hit it, and you're expecting you hit it in 3 weeks, and you hit it in 3 days, you're right. You still make a little money, but it's kind of frustrating.
Henry, aka the Zen Master, how do you manage when you get in a string of bad luck? Let's say, and is there a limit to? I mean, like the UV fly. How long did you test that before you decided that was a thing that you wanted to do?
That's a really good question, because it was a long time. I mean, I studied that thing up and down, and I remember wanting to learn it so much because I could see the potential in it, And I was like, I want to find something that is consistent over time, like, that really offers what so much is marketed in trading. Like, I'm gonna go out there and find that. And I really think the unbalanced fly does that. So I mean, I studied it for years, but I also was always willing to put a little bit of money on ideas. I didn't get carried away with stuff. I would always trade within my means. But I think there's so much to what John said about like the MasterCard trade being done with options. Because if you're trading stock or futures, or especially stock, right? Because so many people get introduced to the market by trading stock. So they'll be in something and it goes against them. Okay, it's basically to the stop. And like Bruce is, there's some of these where it's like you have to honor your plan because your stock, your favorite stock, can go to zero. And you can't let a stock position do that. But if you're just trading through options, there's always, we're not talking about doing anything naked, all risk defined spreads. You really know what you're getting into prior to ever pulling the trigger. So you get comfortable with these derivatives. I think Warren Buffett said that options are like weapons of mass destruction kind of thing. And that's just such a terrible statement, because if you use them correctly, you can actually define your risk much better. So, I would be in those spots where something would go so far against me, and I'm like, well, I've risked whatever I'm getting into it, and then I'm in it for that takeover, or I'm in it for whatever brings it back to do what I thought it might do. So I really just try to focus on options, focus on risk definition, and then just keep on playing it. Just keep on. And there's so many answers to this question, because another big part of it is what you're trading might be more important than how you're trading it. I'm going to do these unbalanced flies, and I'm going to sell them above the market in SPX. If you do that repeatedly, I think you'll do great. Just really think about your strategy, really think about doing it in a repeatable way in a dedicated product. And that's the way that you can build that consistency.
I like it. I also know that you are the Zen master. You know what your risk is, and generally you let them go, right? For me, it's knowing my risk, knowing exactly where my stop is. I use a percentage risk on my options. That's just me. There's no wrong way to do it. If it hits it, I get out. But I also test, right? There's a lot of people, and I know we're talking a lot about AI, with that little NVIDIA company, whatever they do. But AI is only good to a certain extent. So anything I do, bot or not, is real money forward testing, because back testing will always give you the best fills. Always. It can't not, right? It's always just the open and the close of the whatever bar and whatever test. But real money is live markets with things moving all over the place. And it's at least a minimum of 25. Usually it's 50 to 100 before I'll go, yeah, this is a strategy I maybe want to use and want to incorporate. So everybody's different as long as you have a plan, right? When the plan works out, it's great. Kind of the opposite of this, Basant is asking, he says that when I make money, I feel like I take profit too early, assuming his expectations are limited. How do you manage a trade when the market is going up instead? How do you keep in it, I guess, is the essential question there. How do you stay in a trade without freaking out that it's going to pull back and you're going to lose your profits?
Well, I think it's like something like this too. And Henry's really good at this in terms of, kind of sticking with the trade for the duration of kind of the plan, especially if it's directional, and it's a little different. Like with Bruce, if it's doing a butterfly, a lot of it's more time-based. But, I think a big part of it, and I had to do this early on, is you really ask yourself what's making you nervous, right? And a lot of times it's looking at the fluctuations of the P&L. So either I haven't done this in a long time, but I've done this before, especially when I was day trading futures, is I take a little business card and just tape it onto the screen to cover my P&L. You can do other things today, for that, but it's really the fluctuations of a P&L that freak people out. So part of it is as simple as stop doing that. And, it's like when you tell the doctor, like, well, it keeps hurting when I keep doing this. He's like, well, stop doing that. So that's part of it. And the other thing too, and, it's really okay to, this is a Mark Douglas concept, to take the profits when offered to you on a scaled basis. So if you've got 10 contracts and let's say that you're using fib extensions, as a target, this came into play. I don't know how long ago this was, maybe a month ago, or maybe 2 months ago, we're having call options on CRCL, and okay, if it gets to the 1272 extension, great, let's take some off. If it gets to the 1618 extension, great, let's take the rest off. And then it just goes another 100 points. Like, that happens, but it's rare. But I think the main thing is really getting clear on why you're selling. And if you're selling because you're super nervous about losing your profits, that's an absolutely much different reason than following a plan. And I get it. Like, we've all had, profits that have disappeared, but just understand, the reason, behind what you're doing. And that's really the first step.
Bruce, I mean, I know you're a fan of scaling in and scaling out too.
Oh yeah. Yeah, that's what I was going to say is, the first thing would be to scale in or scale out. What I've done this year, a lot more, probably because of the movement in the market, a lot more than normal, is I will leg into the other side, meaning I have a debit spread and we'll overshoot it. I mentioned overshooting. I've done that a lot just because of the moves we've had. So I did it twice in Tesla, put a debit spread out there and pay, $2 for a debit spread. It goes up, you're fully in the money, it's running, but it gets there early. What do? Well, I go up and I'll try to make sure I'm not going to overshoot the upper end, but I'll sell the upper end, call credit spread on the upper end and turn it into a long condor, get $2 for that end. Now you bought it for $2, you sold this for $2, you have zero risk on the trade. You've increased your profit pretty dramatically in the center. And on the one we have right now, I've got like 80 points of room, top to bottom. I don't think I'm, and like 2 weeks left on the trade, whatever. And we've done that over and over and over this year. And if you take all of the risk off the trade, or even some of it, take half the risk off, whether that's scaling out of contracts or trying to add something on the other side. I think Henry likes to do that too. If you sell something, you can buy something against it. Or if you have say you have a butterfly and it's going whatever, you throw a put credit spread on the downside to bring in some more money and kind of offset, but it's, just trade management to me, honestly. But the last thing, I mean, I probably leave more profit on the table than most people, I guess, because I stick to my plan. If my goal is 20% on the trade, I hit 20. Maybe I give it a little more room if things are really going well and I've got a lot of time. But if my goal is 20, 30%, I hit it, I'll go find something else to trade and do it again.
Do you ever go
Uh,
back and look at it and then regret it?
Oh, all the time. Yeah, I do.
No regrets.
Exactly. But in a market like this, it is, if you're trading, Hood or Meta or any of these names that are running so much, you can, you jump off one horse and get on another one, and you just lather, rinse, repeat, and do it over and over and over and over. And, you know, but yeah, I just follow a pretty disciplined plan. And sometimes most of the time it's great. Sometimes it's like, I left a lot of money on the table. So,
Henry?
I think those are all great pieces of advice. And it took me a while of studying this to realize that my little thing that I think I came up with this actually fits in with mastering the trade, because it's MTT. And that is that most people will think about their profits by one of these methods. And that is either monetary, which I think that was the question, right? People look at like, I've made 20%, I made 30%. It depends on the strategy, but you're thinking about the monetary gain. So you lock it up because you've made so much money. Then the other way is technical. So I made a 1272 extension, or I made whatever it is. That's another, a method that a lot of us learn. But when you talk about how I'm so willing to hold positions, there's a big part of that considers a target in time, right? So sometimes you'll hold an option to expiration and it will go to zero, but then there will be other times that you hold that option. And for me, it's always 7 days, right? It's the 7 days before it expires. Because if you'll go and look at that book, because if you take it into the week of expiration and it has a big pullback or it doesn't go your way, that can really hurt, right? Because you don't have that much time. But when you say, okay, I know I'm risking the debit of the position and I'm just going to see where it goes, well, then your target is a target in time. Because another thing that Mark Douglas taught a lot about is that you have to be willing to take whatever the market is willing to give, right? What if you took 7 points out of it, but there was 17 points to be had? Well, you have no idea how much it's willing to give unless you're willing to sit there for whatever that duration is in time. So I would just say, think about that. And again, easy to remember, right? Because you're either thinking monetary, you're thinking technical, or you're thinking a target in time. And if you're thinking, well, I'm just going to, and if you start 90 days out, you could say, well, 2 weeks before expiration or what have you. But I'm just going to hold this option for this much time. And then when I would have those where it's like, wow, that gave me, 400%, where I only thought I would make 30%. That's a way to keep yourself in that trade a little bit longer, a lot longer.
No, a lot longer. Yeah. How do you position size? What for you is a reasonable position size where you don't feel like you didn't put on enough or you don't feel like you put on too much?
Well, what's nice about options is you don't need to trade a lot. You don't need to use a lot of your available capital, which, I think that's important to understand. So I find as a general rule of thumb, take what your goal, like what is your annual percent? Because a big part of this is intestinal fortitude on the part of the trader. So think what you would like to make in a year. Okay. So if your goal is to make 100% a year, okay, I believe that it turns out the risk per trade that makes the most sense is around 5%. Now that means max risk per trade. That doesn't mean that, if you got $100,000, you put $5,000 into options, and if the trade starts working against you right away, you just hold on to it and hope for the best. That's not what that means. That just means, worst case scenario, that trade's going to lose, kind of 5K. So in that kind of a situation, so you've decided on your aggressiveness level, okay, because that's important. If your goal is to make 20% annually, you're not risking 5% a trade, you're risking 1% a trade. So you got to get that dialed in. And then let's assume it's 5%. And then you start doing things like, okay, am I going to buy $5,000 worth of calls here? Or am I going to sell put credit spreads where my max loss is $5,000? So now all of a sudden you start getting into kind of a strategy, because the pros and the cons there are, look, if you buy calls on CRCL and it goes from 150 to 300, obviously that was the right choice. But most of the time, if you're buying calls, 70% of the time at least, it's going to stay within an expected range, and your calls are going to erode and stuff like that too. And so then you think like, okay, well, what kind of equity curve do I want? And if you want something that's fairly smooth without a lot of ups and downs and things like that, then you're like, okay, well then I'm going to sell credit spreads. And so there's things like that. And so now once in a while, I've done some bigger trades, and what'll happen in a situation like that is, when I was like some of the Tesla trades that I did, 2020, 2021, where it's like, oh my gosh, this is it's a $2 million trade. So that's a situation where it's, it's a more intense situation where it's like, all right, I've got 20% of my account in this trade. Now, I just don't recommend that for someone who's just starting out. That's something where it's kind of a combination of experience and willing to take the risk and things like that. But it's still not a situation where it's like, oh, I'm all in. It's a big trade, but it's not like, let's not be stupid here. So if that makes sense, but it really just, you've got to define, what your business is trading and what's your end goal here. And I think trying to double your account is very reasonable. I don't think that's a huge stretch if you're aggressive. But it depends where you are. I mean, for some, 20% is plenty, depending on what your goals are in life. 100% is kind of a combination of, well, I'm looking to grow my account, but I also need to take money out of my account. Okay, so what does that look like? Now, if you're going to like, oh, I want to do 1,000%, that's if that happens, that's more, it's a combination of, there's luck involved in that. I mean, I did that in 2020, and Tesla like went up, like quadrupled that year, and so like, okay, yeah, you're gonna have a good year if you're right in that. So I don't know if that. I'm happy to do a follow-up question there if that didn't answer it, but to the extent that I do a position size in the room, keep in mind that whatever position size I'm posting is completely irrelevant to your own account, because I'm doing that based on the account I'm trading and the goals of that account. And if I'm doing like, say, 100 lot, right, and you've got a 10K account, and I just bought 100 calls at $1, you absolutely better not be buying 100 calls at $1, right? And so that's something to also kind of keep in mind as well.
Henry,
Yeah.
I noticed that you mostly post 1 lots, but sometimes you get like 3. Is that kind of your?
Well, I like to try to keep it consistent, and I also, I think Tasty gets a lot of slack for that phrase of trade small and trade often. It's like, oh, of course you're going to say that because you're a brokerage. But the truth of it is I think that that phrase is actually quite good, and then they protect a lot of people by saying that because you're never going to go broke trading smaller. When you know it's time to trade bigger, you will have that intuition, you will have that experience, you will have, so many of these things. And a lot of these questions are asked by people that are newer, right? So if you're like, oh, well, I feel like you're trying to grow the account, you're trying to push it and this and that, scale it back just a little bit because it is so easy to blow out money when you're new at this. So just scale it back and just realize, you don't jump into med school and immediately go into a surgery, or there's so many vocations where you can talk about, competing at the highest level of that vocation versus when you first darken the door. So as you start walking in and trying to get a feel for it, just always trade smaller. And the other thing about trading smaller that always helped me is that I could see more hands. I think about the poker player that has seen 10,000 hands versus the player that's seen 1,000. So if you want to see 10,000 hands, play more positions, but do them small. Trade a bunch of stuff really small to understand what you're doing. And that'll go a long way towards teaching you, what your setups are. And then, no, not too dissimilar from John, but my favorites and biggest and best trades are usually in stuff like Tesla, where there are so many things that line up. A big piece of it is high short interest back when Tesla had that. Also being, kind of got that cup and handle right under a breakout point. There's just going to be those spots where now I've seen this 10,000 times. I know that the odds are a little bit better. So maybe I'm going to take 3 or 4 times my exposure, right? I'm not saying all in, again, because whatever news could hit, something could fail. But also think about, for me, kind of maybe the final part of that is, again, the product. Because if you're trading like that in a biotech and it gets hit with some news or whatever it is,
Hims is a good example.
Yes.
you took the words right out of my mouth. Yeah, because Hims just looked, it had everything there, but then, part of their whatever that thing was fell through. Well, that's going to be a little different than something like maybe Amazon or Tesla, or, to me, biotech and pharmaceutical is the most vulnerable. Like those things will look perfect and they just get smashed. So I was like, I'm just not going to trade that. So trade small, trade often, know your products, and that's how I would answer that.
There you go. Bruce, do you have
I
any
think so.
particular ways of doing that?
Yeah, same thing. I mean, trade small, trade often, absolutely. And I guess the number one thing is each trade, personally, I try to size them all about the same size, say $5,000, $50,000 account, $5,000 positions, do 10 positions, whatever, and think of it as and everybody's different. You can think of it as a portfolio because you're going to put other trades on and you have 3 or 4, 5, 6, 7 trades going on. Or you can say, I've got $10,000 here. I'm going to trade one position at a time. That's different, so how everyone has to approach it, their own way. But in one of my presentations, I actually did the math and say for a $25,000 account, I think the number was like you had to make $104 a day to double the account in a year. I mean, you can make $100 a day trading pretty easy, you know, and of course, that's say you do it every day and you never have a loss and all that kind of stuff. But the point is, the math says you double it on $100 a day. It's peanuts, right? So you don't have to swing for the fence and do all that kind of stuff. And for me, again, personally, if there's something that I really like, a position that I'm going to take in whatever, I will still size it about approximately the same as all the other positions. It's just another trade. It's very routine for me, you know, assembly line kind of thinking. If it starts working, I like it. We can always add more. If I've got a trade that, out to September, I can add one to October, that kind of thing. You can always add more. So I would just say be cautious about getting all excited about something, just like Henry was saying, this is the best chart. Everything looks great. Because I think we all were in hymns when the rug got pulled and there was no early warning sign there. And luckily, I think all of us sized very appropriately and it was not a big deal.
Hmm. Yeah. One of the things that you all have been talking about is the I can't remember the name of I think it's the mathematics of 3. That's it. Eric wrote a great document that's in all of the room drives, and if you can't find it, it's on all the rooms. Click on the file. that details out exactly what they were just saying about being able to double an account, or when you're oversizing, how quickly it can go down. If you're down 50% in your account, consider that in order just to get back to break even, you have to double your account size from where it is right there. Right?
Yep.
Doable, but not easy, right?
Not easy.
Versus $100 a day for me. I've been telling Trish, I have a goal of, day trading $300 a day. When I'm done, I'm done. Most days I make it and a little more, but when I don't, my average, I'm looking at my average. I'm not looking every day, because if you look at every day, then you start freaking out if you have 2 days that are red in a row because the markets are going bonkers, right? So it's always an average and a balance. And yes, trade small, trade often. The Saws says it all the time, but you're right. They do own a brokerage, but they, he'll short with. I was watching him today, shorting the indexes with both hands, as he says. He was shorting, but he was using micros. So even though he's shorting like crazy, he's got the dude's worth millions, right? But he's still not risking millions of dollars in any trade, and he's in and out. If he's wrong, he's wrong. So it's kind of a good lesson. Michelle, thank you. Well, everybody. She says 0.257% growth per trading day doubles the account in a year. And I think you're right. And that information is in that document that Eric wrote. It's really, really helpful. So take a look at that. And if you can't find it, let me know. So this is probably a good question that will help out a lot of people, particularly the new folks on this call. And is Zane's asking, we have a lot of people in the MTT room and in some of our rooms, right? We have multiple traders. What's your best advice for someone to navigate how to follow these people and not get over leveraged and not get overwhelmed? I start with Henry, because I know people have asked you this a few times as well.
Well, it's kind of a tough question, honestly, because I think every person that presents, there's something to learn from. Like there'll be some piece of their tactic or their approach that will resonate with you, and you learn to incorporate that into your plan. So don't feel like you're going to follow one person and figure out everything that you need to know from them. And I know, especially in the beginning, it's going to be tough to listen to everyone intently. So maybe narrow it down to whoever you resonate with the most, but listen to them completely. Take those few pieces and work to making it into your own plan. And, because at the end of the day, we all want to be our own fisherman, fisherwoman. You take a few tactics and just know that you're learning those pieces to make your own plan. So I would say that helps. And I don't know, that's probably the best advice I would have for that question.
Well, and just a brief follow-up on that. What do you do when two of us in the room have conflicting views of the same ticker? How do you manage that, especially if you're new and you're looking for advice on how to trade something?
I talk about that so much with traders in the room and traders that that I have conversations with throughout the day, and realize that there's actually a lot of power in that. You would think you come to listen to a group of people and it's like, oh, they're all gonna, they're studying one methodology, they're all gonna think the same way. But you actually are going to learn more when you see that conflicting opinion. I mean, honestly, can't even give you a better example than this afternoon when John sold the call credit spread on NVIDIA. So he did the call credit spread. I did the out of the money unbalanced flies. Are those really differing ideas? There's actually ways that both of those will make money. But for me, it's realizing like, maybe a little overly optimistic, maybe, and again, earnings are always kind of a little bit of a tough spot, but look at the differences and look and see how they conflict. And maybe they're not as conflicting as you think, right? Maybe they're actually, because that's the thing, if I'm talking about being long or short stock, well, then that's very binary. But when you think about trading options, it's kind of like playing a 3D chess game. Like there's a lot of different ways where we could all be right. So, he might make money and our spread might make money too. So realize that first. And then the only other part I would answer with that is I really think you want to trade with the trend. Now, again, I know John's probably the best one at trading counter trend, and maybe some people will resonate with that more. But everyone else in the room that I follow most of the time, and everyone that I've read over the years, wants to be a trend trader. And I just think that's whatever you're doing, most of the time, try to go with the trend. Outside of that, understand the differences of the conflict and you can really get a lot of knowledge out of that.
Nice. JC?
Yeah, no, it's interesting too, because, there's the beauty of if there's two people that have different opinions is exactly that, because on a trade there are two sides to every trade, and there could be something that's making new highs and somebody loves it long, and someone else may be watching it going like, yeah, volume's dropping out, whatever, I'm going to buy puts. And so it's always important to understand that there's always going to be two sides to a market, and that at least gives you an inkling, like thinking of who's on the other side of the trade. That being said, as Henry said too, is that if you're trading with the trend, it's the trend is your friend until it ends. It's going to make your life the easiest. There's another type of trading that's called reversion to the mean, which is oftentimes counter trend. And so so I think probably the most confusing thing could be something like this, where and I'll use Henry and I as an example, where Henry's like, I am long SPY and I'm holding it for the next month. And I may just see something saying like, hey, I think we're at a point where we'll probably pull back to the 21, and I might do some bearish trade the last 2 or 3 days. So sometimes that can kind of confuse people, but if that makes sense, but it's like, yeah, the overall trend is up. And realistically, most people, probably including myself, shouldn't spend too much time counter trend trading. But a lot of times it comes down to time frame. The biggest, I think, challenge is if you've got a stock, even in the room today, Nvidia's got earnings, and we're putting earnings trades on it, and there are a lot of people that are just given all the reasons, like, look, this is going to be the most bullish quarter ever, this thing's going to be at 200, and other folks are like, it's probably already priced in, right? Because so at the end of the day, nobody knows anything. Nobody knows anything that's going to happen, and you just either you're following the trend and different things like that. But I would just say that are the best trades where you see 3 or 4 people and they're all in agreement on it. I think that's fair to say, but also just kind of it's another factor in the market, and I think it's actually super valuable to see what is the person, because if you're buying something, someone else is selling it to you. So why is the other person, what makes you think you're right and that the other person on the other side of the trade is wrong? And so it's good to also kind of have that dialogue as well. It's healthy.
I like it. Bruce?
Absolutely.
I know you're not in the MTT as often, but you're one of
Not-
the people that might be counter trend to some others.
Right, right. Absolutely. And I would say it goes back to each person trading has to narrow down their trading style and their time frame. So if if you are like, man, every time I do a butterfly, I get whacked. I don't like doing that. Just don't do them. Find something that's working for you. Or, I love following whoever, but the time frame, they're in and out and, 10 times a day, whatever. I just can't do that. That's not for you then. You got to figure out what your trading style is first and your time frame, and then follow somebody that's resonating with you and the type trades you like and the time frames you like and all that kind of stuff, as far as moderators in the room. But I totally agree with John and Henry both that, I mean, and I listen to everybody. You learn something from everybody in there. I mean, even people in the chat, I'm like, well, I didn't think about that, on that trade or for that trade, or you got hundreds or thousands of eyes and ears on the ground looking at a stock we're looking at, and especially if it's a symbol that's kind of off the radar, you know, somebody says, this happened or that happened, or what about this, what about that? And I'm like, oh man, I didn't see that. I didn't think about that. So all that back and forth helps. So, I guess the number one thing is kind of find a style that resonates with you. Find out what your style is first, and what you're good at. What time frame is very important. I'm probably a little bit further out on time frames than most people, usually in the room trading. And I like the short stuff too, but I kind of blend it, across the board from weeklies to 30 to 45, 60 days out.
One other thing, Aaron says, this is my 5th year at Simpler. So thank you, Aaron.
Yeah, thanks, Aaron.
I've learned 99% of what I know about trading options and futures from the team, and he just wanted to say thanks. So I think
Awesome.
that is a great place to end it. Yeah. We generally have these the last Wednesday of every month, unless the markets are closed or it's a weird day and we have to shift it. But otherwise, that's the general rule. Okay. Thank you, everybody.
Thanks, Lorna. Thanks for also being a great hostess.
Yes, thank you.